this is Jeffrey Towson at Peking University. This is part 2 of our discussion with Jonathan Woetzel of McKinsey and Company on urbanization in China and to a large degree around the world. So in part 1 we talked a little bit about the future of urbanization, how it's going to be different than the past. In this section, part 2, we're going to talk about property developers, who are some of the most high-profile individuals, companies in China, and you could ascribe a lot of that to urbanization. So I guess first question is, how do you see sort of the fortunes and maybe risks of real estate property developers of China going forward?
Well, let's step back. And so real estate in China is kind of a funny thing because it's at least 2, maybe 3 businesses. There's the business of land development, which is kind of what the government's in. So the government has a certain piece of land, and they put down the road, and they put in the basic sewage and connect up the grid, and that's a piece of the business. Second big business is then property itself, is putting the building on it. And the building is largely a commercial, privately led, invested. Sort of like over 70 or 80% of the fixed asset investment that goes into property is coming from the private sector. It might be somewhat state-owned or state-influenced, but it's commercially done and it's intended to get a commercial return. And then the third is the investment business, because if you're an average Chinese middle-class person and you're saving 40% of your income, which is what you're doing, you got to put it somewhere. So you can either put it in the bank and earn basically nothing. You could put it in the stock market, and that would be a casino, or you put it in real estate. And so those are the 3 businesses that we've got here. Now, how did all this take off? I mean, it was the government basically doing a gigantic land grab back in the 80s. When they basically gave cities like 3x, maybe 4x their land area. And they said all that agricultural land, now it's urban. And that means you can build on it, because you can't build on agricultural land. And that's what it's for agriculture. So that was the big start. And that gave all of these cities basically currency. So that started off that government business of let's develop this land, which I bought or I got given essentially for very little. I develop it and then I can sell it, maybe not for a lot of money, but I can sell it for 2 or 3x. And what I do then is I develop it. And so I give it to a developer. Now a developer is getting this land, and it's a private developer, and they're auctioning it. So they're getting it by auction. So in fact, in 1979 was the first land auction in China. And it took place in Shenzhen, which was not an accident, because the government of Shenzhen realized that, whoa, we're actually onto something here. This capitalist economy works, but I don't have any cash. So where is the cash going to come from? And then the light went on and said, oh, we're going to auction the land. And because we got all this economic activity going on, that land should be worth more than it was. And so that's how we got development started. So government is in it to say, okay, I just want to monetize some of all of this economic activity. And so developers were fairly straightforward people. They just said, well, what's the easiest way to me buy from the government and then sell to the consumer or sell to the marketplace? What's the format they're going to do? And it was very simple. It was residential. That you were basically selling to this emerging middle class that was urban. So developers started by creating big, think kilometers of villas that all look exactly the same. And that was it, is as big as you can go, as simple as you can get, and put it out there so that, the middle class guy who's thinking, how do I take the next step? I want that product. And so that was what the developers did. And the bigger ones win. And very local, because you're dealing with local government. And so your relationship to local government to get that piece of land, whatever you were willing to pay, very important. So every town, every city wound up having its developers. Bigger towns had bigger developers. So the biggest developers were the developers in the biggest marketplaces. And they started to grow by acquisition, and so by going to other towns and buying up smaller developers, but leveraging their capital. So that was the developer side. And then the third part is this investment side. And that's kind of the most interesting, because that's what's driving it all, is this massive savings rate. And so where does all of that go, and how do you balance, how do you avoid a bubble? And China's had a few real estate bubbles. I know, I personally participated in a few of them. And you can argue we're heading towards one right now. But if there's one part of the economy the government pays a lot of attention to, it's the real estate economy. They know that if you allow the bubble to form, sooner or later, someone is going to have to pay for that. And that, in this case, would be the middle class. And the middle class will be very unhappy with the government when that happens. And so there is a big concern from the government side of how to manage transactions. So a Chinese real estate depression does not mean dropping prices. What it means is a complete and total dry up of liquidity. There's no transactions happen because no one is willing to buy at that price. And so, therefore, no one sells. And that works because the Chinese consumer, again, is a massive saver, so they're just not that leveraged, so they don't have to sell. That's what a Chinese real estate depression looks like so far.
Within this idea of a real estate bubble of some type, would you look more to overcapacity, or is this more a function of debt and leverage?
I think that it's both, in the sense that China, in many cities, has extraordinarily high vacancy rates and rising real estate prices. Now, why would that be the case? Now, why would you have like really enormous vacancies, look out in empty buildings and such, and yet prices continue to spiral, apparently robust demand? Well, again, it's back to this savings vehicle, saying you just have so much demand for investment vehicles, places to put the money, that it's overwhelming the short-term return. And so you're looking at, and so essentially real estate in China is a 20 to 50 year option contract. And you're buying this piece of land, or the right to use this piece of land, actually. In the case of real estate, it's a 70-year contract. And in order to buy that option, you have to promise to put something on it. Well, the good news is that it's cheap to build stuff. So you build something really cheap. But the value is not in the building. In fact, you will likely knock down the building. And the average life of buildings in China is something like 25 years. And so it's in the land. And so you're taking this punt that in the next 10, 20 years, this land will be worth more because of economic development in this urban area. And that's not a bad assumption, usually, because, first of all, government is not converting urban to agricultural to urban land anymore, so they aren't making any more of it. Right. And we have, again, massive growth in urban income, 3x, 4x. So, but you can always pay too much. So it is still a bet. It's still very much of a bet.
In terms of real estate developers, I mean, if a lot of the previous game was, just a rapid cash flow cycle, buy the land, convert it into cash by putting a lot of residential, quickly sell, do it again.
Right.
How does that game look now versus back in the 90s when there was a lot more of that?
Well, I think the main thing is it's more expensive. Everything is going up. So I think when China used to have 60,000 real estate developers. It's the most incredibly fragmented real estate industry, in fact, almost of any industries. And the top 10 players maybe had 15% of the market, right, compared to OECD markets where the top 10 might have 40% of the marketplace. Right. So just really, really fragmented. And so now, of course, things are more expensive. Land is more expensive now, and costs of building even are more expensive. So it squeezes particularly the smaller developers. And the smaller developers who don't have enough capital to kind of create something which is at scale, which is much more attractive and which can afford a premium, or can be integrated with a big transport piece of infrastructure, for example. So smaller developers are getting squeezed. Larger developers are now still in that race for who's going to be the biggest developer, who's going to be the guy who dominates the stock market, who gets the most capital into their land bank. And so there's pressure at both ends. There's pressure at the small end to sort of survive on what is an ever more squeezed margin, and there's pressure at the top end to be the premium player. Because if you're not, then someone's probably going to think of you as part of their premium. They're going to try to buy you out. So there's a lot of competition, and I think that drives a couple of things. First of all, skills. There's much more of a premium on creating unique products, things which will capture that premium. And so architecture, the urban design, the engineering, the marketing and understanding of the customer. It's a lot more of a skill and a talent game than it ever was. So that's one big thing. Secondly, there is capital. I mean, there is now this, there's a real competition for capital and the access to capital. So bigger is better when it comes to capital, which means the state connection, again, is better. So that may be not a new thing, but it's just going into another cycle. And so that instead of a city having like 5 or 6 big developers, they might have 1 or 2. And that will drive some consolidation in the sector. And then I think the rest of it is interesting because it's going to be a lot more heterogeneous, if I sort of complicated word, but saying people's needs are becoming more complicated. And so we see new, different kind of real estate developments, whether it's transit-oriented, environmentally oriented, socially oriented, and now increasingly affordability-oriented. So whether it's like Chijiuba, the 798 district, the arts district as a model for a cultural district in Beijing, or of course Xi Jinping came out and has said, houses are for living in, not for speculation. That's going to create a real problem for a lot of people. And say, but it also maybe creates an opportunity, saying, how do I make houses that are for living in, not for speculation? So.
Okay, sort of, I guess last question is, the China shorts, a lot of them outside of China, are very famously talking about debt levels, right? And often that conversation turns into a discussion about real estate or local government, other things. I mean, how do you view, is housing and real estate related debt, the potential large-scale problem that is often pointed to as, being potentially that?
I think that it will be it's like, the location of the problem, but whether it is the actual cause of the problem, I'm not sure. That, it's probable that China will have a funding-related restructuring of its financial system at some point. It's done it twice already, back with the early days of Guangdong, and then what Zhu Rongji did with state enterprises. And so it's not unreasonable to think that China will go through this again. And we know that debt is rising, largely corporate debt. It's not sovereign. So the implication of that is that it can and probably will be restructured. So people should be aware of that. And a large portion of that is in what we'll call local government financing vehicles or other infrastructure-related investment vehicles, which have a lot of real estate associated with them. So yeah, at some level, a large portion, it couldn't be other than that, 25, 30% of the assets of any financing investment vehicle will probably have real estate in it. So they'll be associated with it. But as I said, I don't think that there is necessarily a problem here given the level of demand that we're talking about for real estate and the time frames. Real estate's a long-lived asset, and it's supposed to be there for 30, 40, 50 years. And in that time frame, China still has nowhere near the amount or the quality of residential, let alone commercial, real estate that it needs. So if there is a problem, it's a mismatch. It's too much short-term funding being invested in what should be a long-term appreciation game. And that can catch up with you, particularly if you have short-term liquidity requirements. And that's where you would expect to see it. So that some small commercial bank from a city commercial bank in an area which has not as much economic activity and they need some cash, but they put all their cash into a real estate projects and then they try to liquidate the real estate project and it doesn't happen, then all of a sudden you have this pressure to sell, which you don't have right now. But it can happen and it probably will happen in some particularly smaller cities. So that's where I would see the risk. But it's nothing that the system in a sense can't handle. What will then happen is there will be what happened before, a move towards asset management corporations and people, and there'll be restructuring, and so the good assets and the bad assets will be split up, all of which can happen, but usually takes some time and has some collateral damage, particularly to the private sector. So the small guy, the small factory is the factory that then doesn't get its loan because the Citibank is getting restructured. So that's what happens to the economy. That's where the dip happens. So it's the location of the problem, but I don't think it's actually the problem itself. I think the problem itself is you can say undisciplined and overly rapid growth of the credit side of the Chinese economy, and the lack of investment alternatives. Because again, real estate's these three different businesses. It's the government business, it's the development business, and it's the investment business. And because the investment business is basically the only way to invest, well, yeah, you're going to get a lot of shady investment. You're going to get a lot of people who probably shouldn't be investing in real estate, but yet they're there because there's nothing else for them to do.